Well, both Brent and US crude oil have been trading around the $80 to $85 a barrel level in August, although Brent hit $87 on the 10th of August and US crude also went up to 84 the same date, driven by increasing signs of a tightening market. However, demand concerns in China has also weighed on crude prices more recently as investors consider the impact on oil in the world's second largest economy. Well, let's go live now to energy and economic analyst Osama Rizvi for more on this in Lahore. Now, Osama, you are somebody who certainly keeps across the oil market, and there's a lot to go through at the moment. So I'm going to try and ask some of the questions that our investors and traders might be interested in. Firstly, Osama, EIA weekly data showed on Wednesday that US oil production remained for a second week at 12.8 million barrels per day, which is the highest it's been since March 2020. Now, Baker Hughes' weekly oil rig count shows an almost constant decline in the number of oil and gas rigs in operation since the start of the year. So in numbers, producing US oil rigs in March 2020 around 680, producing US oil rigs in August 2023 was at 512, yet producing same amount of sort of crude oil. So what do you make of this data, Osama?
Thank you so much, Angela. I think it's a very interesting question, and you have to look it from a different perspective. So there are 3 or 4 main reasons for this. First of all, we all know that this year has been quite good for the big oil or the oil producers, in that they registered record profits recently in the previous year. So higher oil prices certainly has incentivized oil producers to produce more. However, as you mentioned, this is happening with the reduced amounts of rigs, which is primarily because of, first, the well productivity has gone up recently due to technological improvements, and also because of the recent, learnings from the oil price war and how to keep afloat during the lower oil prices, time period. So that is the first thing. Secondly, drilled but uncompleted wells, the DUCs, they have gone up. The number of DUCs going up has also been one of the contributing factors to this. And thirdly, refracs. There seems to be, that there is a lot of focus right now on environmental friendly technology and environmental friendly ways, all the while keeping oil supply the same. So refracs comes to the rescue, and the amount of refracs and the oil being recovered from refracs, that has also gone up. So these are the 4 or 5 reasons primarily contributing to the increased or sustained oil supply despite a fall in oil rigs.
And Osama, you and I have talked a lot about oil prices in the past. Is it going to hit $90 at times? Is it going to reach 100, go over 100? My thoughts are, obviously we're at this $80 to $85 a barrel level in August, as we were talking about as well. But what's your stance on oil prices in the short and the longer term?
Well, Angela, you know that I have remained a bear throughout the start of this year. And I know there has been some spikes, some extraordinarily swings to the upside in the oil prices. But we saw that despite this recent rally, oil prices failed to break the $90 psychological mark. And now there is this physical market, and then there are paper markets. When you talk about fundamentals, and I'm going to talk about fundamentals for now, you see that all the fundamentals, all the major global economic indicators that are significant contributors to prospective demand increase, they're all down. They're down to extraordinary levels. For instance, Eurozone's PMI is at a 38-month lowest level. Germany is about to enter a second recession. The construction activity in the country is going down. You look at China. Yesterday, Chinese economic figures came out, and the factory output has shrunk for another month. It's been consecutive, I think, 6 or 7 months that this is happening. The official and non-official PMIs are below 50, indicating a contraction. If you look at US, the largest economy in the world, their economic indicators, starting from industrial supply of electricity, to ISM manufacturing, to leading conference boards, leading economic indicator, to inverse, treasury yields, all of these indicators clearly, blatantly point towards a global economic slowdown. Then you have the other markets, which are the paper markets. And in the paper markets, it happens a lot of time that fundamentals are ignored and sentiment reigns supreme. And at times there is this thing called over-representativeness of good news. And that is what I think was happening recently. You had OPEC Plus promising to keep the production cuts. You had, China cutting down its interest rate, quelling the fears of investors, and things like that. That led to the rally. And I wrote that at that point that this rally is not sustainable. I, for now, in the short run to the medium to longer run, remain on my bearish stance. I think there might be a spike due to the hurricanes we are facing right now. However, from the medium to longer term, I think prices will head down. I think if there is a proper recession in the major economies in the world, we might see oil heading to mid 60s before the end of the year, or otherwise in the mid 70s for sure.
Wow. Okay. So mid 60s before the end of the year. Okay. So how should investors, Osama, be positioning themselves whilst oil markets remain so volatile?
I think it's better to take not short as in they should sell, but I think it's better to trade on a shorter term rather than a longer run right now, because there seems to be an extraordinary amount of uncertainty and volatility across the world. You don't know whether there would be a geopolitical flashpoint that will just take oil prices into the triple digit area, or there would be some news regarding the Chinese economy that would plunge the oil prices back to 60s or 70s. So I think traders should keep a keen eye on the second largest economy of the world, that is China. Continue to follow its indicators. I think they're not looking really good at the moment. Plus manufacturing activity in the US and the Eurozone, because oil is the strategic component that lubricates the factory of the world, and that is the impact is shown in the manufacturing data, right? So Eurozone manufacturing data, US manufacturing data, Chinese manufacturing data, demand in Taiwan, Japan, South Korea, and things like that. So global economic indicators pertaining to the real economy, not the financial economy, should be keenly observed to track the trajectory of prices in moving forwards.
Brilliant, Osama. Thank you. Well, you went through fundamentals there. You've gone through as well the economic data to keep across. But just one more question on economic data. Next week, is there anything particular that you're looking out for?
There is a bunch of data coming out from the US and Eurozone as well. I for one, do not subscribe to the idea of looking at a particular indicator. As I said, I'll be looking at a whole buffet of indicators, and which will include economic data coming out of the US in terms of inflation, economic data coming out of Eurozone in terms of manufacturing, and some economic data from China, especially regarding the oil imports.
Okay, Osama Rizvi, energy analyst and economic analyst as well. Thank you ever so much for your insight. As always a pleasure to speak to you. Thank you very much for joining us on IGTV.